Investing is important. It helps you grow your money. Two popular options are stocks and cryptocurrencies. Stocks represent ownership in companies. When companies profit, you profit too. Cryptocurrencies are digital currencies. They use cryptography for security. Both offer potential rewards, but they also come with risks. This guide explains the basics of crypto and stocks. This guide is for beginners. We'll use simple terms. Our goal is to help you understand these investments. Remember, investing involves risk. Always do your research before you start. Stocks are like pieces of a company, representing ownership in that business. Owning stock means you own a part of that company, giving you a stake in its success and sometimes a say in its decisions. Companies sell stock to raise money, which they can use to fund new projects, expand operations, or pay off debt. This influx of capital lets them grow their business, hire more employees, and innovate. Stock exchanges are marketplaces for buying and selling stocks, where investors can trade shares with one another. Think of it like a big auction, where the highest bidder wins the stock. Prices change based on supply and demand, influenced by company performance, market trends, and investor sentiment. When you buy stock, you hope the company does well, as this can lead to an increase in the stock's value. If the company profits, its stock price usually goes up, rewarding shareholders with potential gains. You can then sell your stock for a profit, capitalizing on the increase in value. This is called a capital gain, which is the profit made from selling an asset for more than its purchase price. However, if the company performs poorly, its stock price might go down, reflecting its struggles. You could lose money if you sell for less than you bought it, resulting in a capital loss. Stocks carry inherent risks, even for established companies, and it's important to understand these risks before investing. Cryptocurrencies are digital currencies. They operate independently of central banks. Bitcoin is the most well-known cryptocurrency. Cryptocurrencies use blockchain technology. A blockchain is a digital ledger. It records transactions securely and transparently. Decentralization is key to cryptocurrencies. No single entity controls them. This is different from traditional currencies. Governments and banks control those. You can buy and sell cryptocurrencies on cryptocurrency exchanges. Prices can change quickly and drastically. This makes crypto a high-risk investment. Volatility refers to price fluctuations. Both stocks and cryptocurrencies experience volatility. However, cryptocurrencies are generally more volatile than stocks. Crypto prices can swing dramatically in short periods. This makes them riskier. Factors like regulation and adoption rates impact crypto prices. Stocks are also subject to volatility. Economic factors and company performance play a role. However, stock markets tend to be more stable than crypto markets. Investing in either asset class carries risk. Diversifying your portfolio can help mitigate risk. This involves spreading your investments. Don't put all your eggs in one basket. Section 5. Potential rewards, short-term gains versus long-term growth. In this section, we will explore the different strategies investors use to maximize their returns. Investors aim to earn returns on their investments, whether through stocks, bonds, or other financial instruments. Both stocks and cryptocurrencies offer this potential. But their approaches differ significantly, each with its own set of risks and rewards. Short-term trading involves buying and selling quickly, often within the same day or week. Traders aim to profit from short-term price swings, capitalizing on market volatility. This strategy is riskier, but can yield substantial profits if executed correctly. However, it requires constant monitoring and quick decision-making. Long-term investing, on the other hand, involves holding assets for extended periods, often years or even decades. This approach aims for gradual growth, allowing investments to compound over time. It's less about timing the market and more about trusting in the asset's potential to grow over the long haul. Stocks have a history of long-term growth, often weathering short-term volatility to provide substantial returns over time. Cryptocurrencies are newer, but have shown potential for high returns, though they come with higher volatility and uncertainty. Remember, past performance doesn't guarantee future results. Always consider your risk tolerance and investment horizon before making decisions. Section 6. Case Studies. Success Stories in Stocks and Crypto. Let's look at examples of successful investments. These highlight the potential rewards. But remember, every investment has risks. Amazon is a success story in the stock market. Early investors saw massive returns. Amazon's stock price skyrocketed as the company grew. Bitcoin is a prominent example in the crypto space. Early adopters who held onto their Bitcoin saw incredible gains. Bitcoin's price surged as its adoption increased. These examples are not guarantees. They simply illustrate the potential rewards. It's crucial to conduct thorough research before investing. Section 7. The importance of research. Knowledge is power. Investing without research is like gambling. You need to understand what you're investing in. For stocks, research the company. Look at their financials, management team, and industry trends. Understand their products and services. For cryptocurrencies, research the technology. Understand the blockchain and its use cases. Evaluate the team behind the project. Numerous resources are available for research. Websites, books, and financial advisors can help. The more you know, the better equipped you are to make informed decisions. Section 8. Weighing the options. Pros and cons of crypto and stocks. In this section, we will delve into the advantages and disadvantages of investing in both cryptocurrencies and traditional stocks. Let's summarize the pros and cons of each investment. Understanding these can help you make informed decisions about where to allocate your resources. Stocks. Pros: established market with historical data. Potential for long-term growth. Regulated environment. Stocks have been around for centuries, providing a wealth of information and trends to analyze. Cons: a lower potential for high returns compared to crypto. While stocks can offer stability, they often don't provide the same explosive growth seen in the crypto market. Market volatility and economic factors can impact returns. Economic downturns, political instability, and other factors can lead to significant losses in the stock market. Cryptocurrencies. Pros: potential for high returns. The crypto market is known for its rapid growth and the potential for significant financial gains in a short period. Decentralized and independent of central banks. This independence can be appealing to those who prefer a financial system not controlled by traditional banking institutions. Growing adoption and technological advancements. As more businesses and individuals adopt crypto, its utility and value continue to increase. Cons: high volatility and risk. Complex technology to understand. Regulatory uncertainty. The crypto market can be unpredictable, and understanding the underlying technology can be challenging for new investors. Ultimately, the best investment for you depends on your individual circumstances. Your financial goals, risk tolerance, and investment horizon should guide your decision. Consider your risk tolerance, investment goals, and financial situation. It's crucial to evaluate how much risk you are willing to take and what you aim to achieve with your investments. Remember, diversification is key to managing risk. By spreading your investments across different asset classes, you can mitigate potential losses. Invest wisely and seek professional advice if needed. Consulting with a financial advisor can provide personalized guidance tailored to your unique financial situation and goals.